Let me tell you something about markets that most fellows learn the hard way. A trend never begins with fireworks. It begins quietly, almost politely. The crowd is still looking the other way, the newspapers are still confused, and the price is simply doing its work. And if you've spent enough time studying the tape, really studying it, you start to notice certain signals. Little whispers from the market that something larger is preparing to move. You see, the big money is not made in the noise. It is made in the move that follows the preparation. That's where the patient operator earns his keep. Now let me ask you something. Have you ever looked at a chart and felt that something was changing before the big move actually happened? Not because of news, not because of someone's prediction, but because the price itself began to behave differently. That feeling is not magic, it's observation, and observation is the trader's greatest weapon. The first signal that a trend may be ready to explode is what I call tightening action. The market stops wandering. Price begins to compress into a smaller and smaller range. Each rally is sold a little sooner, and each decline is bought a little quicker. The swings become smaller. The chart begins to look like a coiled spring. Now, why would that matter? Because large operators cannot buy or sell their entire position in one moment. If they tried, the price would run away from them. So they work quietly. They accumulate. They distribute. And when they do, the chart often shows this tightening behavior. Have you ever noticed a stock that trades between the same two prices for days, sometimes weeks, barely moving beyond them? The public calls it boring. The impatient trader moves on, but the professional asks a different question. Why is the market refusing to move lower, or refusing to move higher? When supply and demand begin to balance like that, something important is usually taking place behind the curtain. And the longer that coil tightens, the more powerful the move tends to be when it finally releases. That doesn't mean you jump in blindly. No, the market always demands confirmation, but tightening price action is often the market clearing its throat before speaking. Now here is the second signal that a trend is preparing for a serious move. Volume begins to behave strangely. Most traders look at volume but never really read it. They see numbers, but they miss the story. Let me explain. Imagine a stock that has been drifting sideways for several weeks. Nothing dramatic, just quiet movement. Then one day the price pushes slightly above the range and volume suddenly expands. Not wild, chaotic volume, but noticeably heavier than usual. Now what does that tell you? It tells you that someone with size has stepped into the market. Institutions do not hide very well on the tape. Their footprints appear in the form of unusual volume. But here's the part many traders miss. The price doesn't always explode immediately. Sometimes it pokes above resistance, pauses, and then settles again. That confuses the crowd. They think the breakout failed. But the professional trader watches closely. If that higher volume appears repeatedly during small pushes upward and declines occur on lighter volume, that's often a sign of quiet accumulation. Ask yourself this when you look at a chart. Who is being more aggressive, the buyers or the sellers? Because trends are not built by opinions. They are built by aggressive participation. If buyers step in with size every time the price dips slightly, the message is clear. Demand is becoming stronger than supply, and once supply dries up, price has only one direction left to travel. Now here comes the third signal. And in my experience, this one separates the casual chart watcher from the true tape reader. Failed moves. Yes, you heard that right. Failed moves. Most traders hate them, but to a careful observer, they are priceless information. Let's say a stock breaks below a well-known support level. Every textbook trader expects it to fall. Stops are triggered. Short sellers rush in. But then something curious happens. Instead of collapsing, the price quickly climbs back above that support. Now what does that mean? It means the market tried to go lower and could not. And when the market fails in one direction, it often prepares to travel strongly in the opposite one. Have you ever noticed how powerful reversals often begin this way? The crowd gets trapped on the wrong side of the move. When traders who sold the breakdown realize the price is rising again, they must buy to exit. That buying pressure adds fuel to the move. The same principle works in reverse during bearish trends. A false breakout above resistance that quickly falls back can signal that the market has exhausted its buyers. The lesson here is simple but powerful. Do not only watch what the market does, watch what it tries to do and fails to do, because the market's failures often reveal its true intentions. Now combine these three signals and you begin to see the full picture. A tightening range, unusual volume during pushes in one direction, and failed moves against the developing trend. When these elements appear together, the market is often preparing for a decisive move. But let me ask you something important. Does that mean you should bet everything the moment you see them? Of course not. That kind of thinking is what ruins traders. Successful speculation is not about certainty. It is about probability and discipline. The wise trader waits for the market to prove his idea correct before committing serious capital. You see, the biggest fortunes in trading are not made by predicting every move. They are made by recognizing the right move and then having the patience to sit with it. Most traders cannot do that. They jump in and out, chasing every wiggle of the chart. They treat the market like a casino. But speculation, when done properly, is a business of observation and restraint. Have you noticed how the greatest trends often look obvious after they have already traveled far? That's because the crowd waits for certainty. By the time certainty arrives, most of the opportunity has already passed. The professional acts earlier, not recklessly, but with preparation. He studies the behavior of price. He watches the volume. He respects the structure of the chart. And most importantly, he respects his capital. Because capital is the trader's inventory. Without it, you are out of the game. That is why position sizing matters just as much as chart reading. Even the best signals can fail. Markets are living systems, not machines. So the goal is never to be right every time. The goal is to stay in the game long enough to catch the rare, powerful trends that truly move wealth. And when those trends begin, they rarely announce themselves loudly at first. They whisper, through tightening price action, through subtle changes in volume, through failed attempts in the wrong direction. The question is, are you listening when the market whispers? A curious thing happens in the market when a stock keeps returning to the same level again and again without breaking down. At first glance, most traders see nothing special. The chart looks dull. Price drops toward support, touches it, bounces a little, and then drifts back again, over and over. To the impatient eye, it appears weak. To the trained eye, it begins to tell a different story. Now think about it for a moment. If a stock keeps falling toward the same price but refuses to break through it, what does that really mean? It means someone is buying there. Not once, not twice, but repeatedly. You see, the market is a constant contest between supply and demand. When sellers try to push the price lower, they are offering shares into the market. If no one wants them, the price must fall. That's simple economics. But when price keeps reaching a certain level and refuses to go lower, it suggests that demand is quietly absorbing that supply. Have you ever watched a stock test the same support 3 or 4 times? Each time it dips toward that level, the selling pressure appears, yet the price stabilizes and lifts again. The public often interprets this as weakness. They think it keeps falling back to support. Sooner or later it will break. Sometimes that happens, of course. Markets do break down. But when the level continues to hold despite repeated tests, the more interesting question becomes this: who keeps buying all those shares? Large operators cannot accumulate their positions in a single day. If they tried to buy everything at once, the price would shoot upward and they would be forced to pay much higher prices. So they proceed slowly, patiently, and often invisibly. They wait for weakness. When the stock drifts down toward support, and the public begins selling out of frustration or fear, the professional buyer quietly takes the other side of the trade. The public sells, the operator buys, and the price stabilizes. The chart begins to show this behavior as repeated rebounds from the same level. Now let me ask you something. Have you ever noticed how the bounces from support sometimes become slightly stronger with each test? At first the rally might be small. The price rises a little and then drifts back again. But after several tests, The rebounds begin to travel farther upward. That is often the first hint that the supply available at that level is slowly being absorbed. Each time the price touches support, fewer sellers remain. The weak holders have already sold. The shares have gradually moved into stronger hands. This is the quiet process of accumulation. It rarely attracts headlines. It does not excite the crowd. In fact, many traders grow bored during these periods. They prefer fast movement, dramatic breakouts, and sudden excitement. But the professional understands something important. The most powerful trends are often built during the quietest phases of the chart. A stock that rises sharply without preparation can collapse just as quickly. But a stock that spends weeks holding the same support level while shares quietly transfer from impatient traders to patient operators is building a foundation. And foundations matter, because once the supply above the market begins to thin out, the price can rise with surprising ease. The operator who accumulated shares at support now has little reason to sell. Meanwhile, traders who ignored the stock during its quiet phase suddenly notice the upward movement and begin chasing it. That is when demand finally overwhelms supply. But the early signal often appeared long before the breakout itself. It appeared when the market kept returning to the same level and simply refused to go lower. A trader who studies this behavior learns to ask a simple but powerful question every time support holds. Who is buying all those shares? A breakout means very little by itself. Price pushing above a resistance level can happen for many reasons. Short covering, momentary excitement, even random fluctuation. The chart may show a clean move above the line everyone has been watching, and for a moment it looks impressive. But the experienced trader knows that price alone does not tell the whole story. The real question is this: who is behind the move? Because in the market, not all buying carries the same weight. Imagine a stock that has been trading under the same ceiling for weeks. Each time the price approaches that level, sellers appear and push it back down. Traders begin to recognize the pattern. The resistance becomes obvious. Charts are marked. Alerts are set. Everyone is watching the same line. Now one day the price finally pushes above that level. To the casual observer, that seems like the signal. They see the breakout and rush to buy. But the professional trader looks immediately at something else. Volume. How many shares traded during that push? If the breakout occurs on ordinary or light volume, it may simply mean that sellers stepped away temporarily. There were not enough sellers at that moment to hold the price down, so the market drifted above resistance. That type of breakout can fade quickly because it lacks real commitment from large buyers. But when the breakout occurs with noticeably higher volume, the story changes. Heavy volume means participation. It means larger interests are entering the market with conviction. Institutions, funds, or capitalized operators cannot buy quietly when they decide to move in size. Their activity leaves footprints in the form of expanded trading volume. Have you ever noticed how certain breakouts seem to leap forward with energy the moment they clear resistance? The candles widen, the tape moves quickly, and the market feels alive. That kind of movement rarely happens without strong volume behind it. Volume, in many ways, is the voice of the market's conviction. Price shows direction, but volume shows intensity. When both appear together, price breaking through resistance and volume expanding, the message becomes far more meaningful. Think about what must happen for a true breakout to sustain itself. First, sellers sitting at resistance must be absorbed. Their supply needs to be taken off the market. Then buyers must continue stepping in at higher prices, willing to pay more than anyone was willing to pay before. That process requires real demand, and real demand leaves evidence. If a breakout occurs on heavy volume, it often suggests that the market has moved from hesitation into commitment. The shares being sold at that level are being taken aggressively by buyers who expect higher prices ahead. Now consider the psychology behind it. When traders see a breakout with strong volume, confidence begins to spread. Those who were waiting for confirmation feel more comfortable entering. Short sellers who were leaning against resistance begin to feel pressure. Some of them rush to cover their positions, adding more buying activity. Momentum begins to build, but the careful trader does not react blindly to a single surge in volume. One burst of activity can happen for many reasons. The important observation is whether that strong volume accompanies the move through resistance and continues supporting the price afterward. Does the stock hold above the breakout level? Does volume remain healthy during upward pushes? Do pullbacks occur on lighter volume? These details matter, because sustainable trends are rarely built on weak participation. They grow when capital flows steadily into the market. Many traders make the mistake of focusing only on price patterns. They draw lines, watch levels, and react to every breakout they see. Yet without volume confirmation, those breakouts can become traps. The market often tests traders in this way. A price move without volume can lure in eager buyers, only for the stock to slip back below resistance once the excitement fades. But when volume expands during the breakout, the move carries the weight of real demand. And in speculation, demand is the force that drives trends. So when you see a market finally push above a level that has held it down for weeks, pause for a moment and look beyond the price itself. Look at the activity behind it. Ask yourself a simple question. Are traders merely watching the breakout, or are serious buyers stepping forward and taking shares in size? One of the most revealing moments in the market happens when price tries to move in a certain direction and fails. Most traders see only the movement itself. They see a breakdown below support or a breakout above resistance and immediately react. But the thoughtful operator waits a moment longer. He watches what happens next, because the market often reveals more through its failures than through its successes. Imagine a stock approaching a well-known support level. Traders have been watching that level for days, maybe even weeks. It has held several times before. Now price drifts lower again, and tension builds. Everyone expects the same thing to happen once more. Then the market breaks below support. Charts flash a bearish signal. Traders who were waiting for the breakdown jump into short positions. Stop losses from long positions begin to trigger. For a brief moment the price dips lower, and it seems that the downward move has begun. But then something unexpected happens. Instead of continuing lower, the price stops falling. Buyers appear. The market begins climbing back upward. Within a short time, the price moves back above the very support level that was just broken. Now pause and consider what just happened. The market attempted to go lower and failed. That failure carries information. It tells you that despite the appearance of weakness, there was not enough selling pressure to keep the price down. Demand stepped in faster than supply could push the market lower. Have you ever noticed how quickly traders become uncomfortable when a breakdown reverses like this? Those who sold the breakdown suddenly find themselves on the wrong side of the trade. Their positions begin losing money. And when traders are caught on the wrong side, they must eventually buy back the shares to exit. That buying adds fuel to the upward movement. At the same time, traders who were waiting on the sidelines notice the recovery above support. Some of them recognize the failed move and begin entering long positions. Now two forces are pushing the price higher, new buyers and trapped sellers covering their positions. This is why failed breakdowns can sometimes lead to surprisingly strong rallies. The market briefly fooled the crowd, shook out weak holders, and then reversed direction. What looked like weakness was actually the last push of selling pressure before demand regained control. The same principle works in reverse during upward moves. Picture a stock pushing above a resistance level that traders have been watching closely. Price finally breaks through, and many traders rush to buy the breakout. The move looks convincing at first. The chart seems to confirm a bullish trend, but shortly afterward, the price slips back below resistance. Buyers who chased the breakout now begin to worry. If the price continues falling, their positions will quickly turn into losses. Some of them rush to sell and exit. That selling pressure can accelerate the decline. Again, the key information is not just the breakout itself, but the market's inability to maintain that move. A strong trend usually continues once it clears an important level. When the market fails to do so, it suggests that the opposing force, sellers in this case, remains stronger than expected. Have you ever watched a chart where a breakout failed and then the price dropped sharply afterward? That kind of movement is rarely random. It often reflects the sudden shift in positioning among traders who were expecting the opposite direction. The market thrives on these moments of imbalance. When traders are trapped on the wrong side of a move, their forced exits can create powerful momentum in the opposite direction. The chart begins to move faster, candles expand, and the trend gathers strength. But recognizing these situations requires patience. The careless trader reacts immediately to every break of support or resistance. The careful trader waits to see whether the market can actually hold that new territory, because the truth of the move is not proven in the breakout itself. It is proven in the market's ability to stay there. When the market cannot hold a move in one direction, it often reveals where the real pressure lies, and sometimes the most valuable signal a trader can observe is the simple fact that the market tried to go one way and refused to stay there. One of the quiet forces that drives strong market moves is something most traders don't notice until it is already too late. It happens when sellers become trapped after a breakdown that fails to continue lower. At first it looks like the beginning of a downward trend, but the situation can quickly turn into the very fuel that pushes price upward. Think about how most traders behave around a support level. When price approaches a well-known support line, many traders prepare for two possible outcomes. Some buy the bounce, expecting the level to hold again. Others wait patiently for a breakdown, believing that once the level gives way, the market will fall quickly. Now imagine the support finally breaks. Price dips below the level and suddenly it looks like the bearish traders were right. Charts flash a signal. Short sellers step in. Stop losses from long positions are triggered and forced selling pushes the price a little lower. For a brief moment, the move seems convincing, but markets have a way of testing conviction. Instead of continuing to fall, the price begins to stabilize. Buyers quietly step into the market. The selling pressure that seemed so strong moments ago starts to fade. Slowly, the price climbs back toward the broken support level. Now here is the critical moment. If the price moves back above that support level, the entire situation changes. What was supposed to be a clean breakdown has suddenly become a failed move, and the traders who sold short below support are now in an uncomfortable position. Let me ask you something. What must a short seller eventually do to exit their trade? They must buy. A short position is simply borrowed shares sold with the expectation of buying them back later at a lower price. But when the market begins moving upward instead, the short seller faces a problem. The longer they wait, the more money they risk losing. As the price continues climbing above the broken support level, many of those traders start to feel pressure. Some close their trades quickly to limit their losses. Others wait a little longer, hoping the market will turn back down. But as the upward movement continues, more and more of them are forced to buy back their positions. That buying activity creates additional demand in the market, and when that demand appears during an upward move, it can accelerate the rally. The price does not rise only because new buyers are entering the market. It also rises because trapped sellers are scrambling to escape their losing trades. Have you ever watched a chart where price suddenly surges upward after a failed breakdown? The candles grow larger, the pace quickens, and the move seems to gather strength with each passing moment. Very often, trapped sellers are part of that force. At the same time, traders who were waiting on the sidelines begin to notice the reversal. They see that the breakdown did not hold and that the market has reclaimed the support level. Some interpret this as a sign of strength and begin opening long positions. Now the upward pressure comes from two directions at once. New buyers enter with fresh positions, and trapped sellers add buying pressure as they cover their shorts. The balance between supply and demand shifts rapidly. What makes this situation so interesting is that the move begins with a mistake made by the crowd. Many traders were convinced the market would fall once support broke. Their confidence led them into short positions at the very moment when selling pressure was already near exhaustion. The market absorbed that selling and turned upward. This is one reason why experienced traders pay close attention to failed breakdowns. They are not merely signs of strength. They often represent moments when the market has trapped a group of traders on the wrong side of the move. and trapped traders rarely stay comfortable for long. As price continues rising, their urgency to exit grows. Each wave of short covering pushes the market higher, which in turn forces more sellers to close their positions. The result can be a chain reaction of buying pressure that drives the next leg of the trend upward. One of the quiet truths about the market is that time itself can build pressure. A stock that moves wildly up and down may attract attention, but it does not always produce the strongest trends. In many cases, the most powerful moves come after long periods where price seems almost calm, even stubbornly still. You might look at such a chart and feel impatient. The stock trades inside a narrow range. Day after day it moves a little higher, a little lower, never quite committing to a direction. Traders glance at it, shrug, and move on to something more exciting. But the experienced observer sees something different. He sees pressure building. Think about what happens during a long price range. Buyers and sellers are meeting each other at roughly the same levels again and again. Every time the price approaches resistance, sellers appear and push it back. Every time it approaches support, buyers step in and lift it again. At first this may seem like a stalemate. Neither side appears strong enough to dominate the other, but beneath the surface, something gradual is often taking place. Shares are changing hands. Weak holders who lack patience begin selling when the price refuses to move quickly. Traders who are hoping for an immediate breakout grow frustrated and exit their positions. Each time they sell, someone else is buying those shares. Have you ever noticed how the swings inside a range sometimes begin to shrink over time? The highs become slightly lower, the lows slightly higher, and the price movements tighten. The chart begins to compress, almost like a spring being slowly wound. This tightening action is not random. It often reflects the steady process of supply being absorbed from the market. Each time the price returns to support, fewer sellers remain willing to push it lower. Meanwhile, buyers who believe in higher prices continue accumulating shares during those quiet pullbacks. The longer this process continues, the more important it becomes, because markets move when the balance between supply and demand shifts decisively. During a prolonged range, that balance is gradually changing even if the price has not yet shown it clearly. Imagine a warehouse slowly emptying of available goods. At first there may be plenty of inventory for buyers, but as time passes and more of the supply is taken, fewer items remain on the shelves. Eventually, buyers must compete more aggressively to obtain what is left. Prices begin to rise. The market works in a similar way. A long consolidation period often means that available supply is being quietly reduced. Once that supply becomes thin enough, it takes surprisingly little demand to push the price upward. This is why breakouts that occur after long periods of consolidation can be so powerful. The market has spent weeks, sometimes months, preparing for that moment. When price finally moves beyond the range, there may be very little selling pressure left to hold it back. Traders who ignored the stock during its quiet phase suddenly notice the movement and rush to participate. Momentum builds quickly. Have you ever watched a chart where a stock stayed quiet for what felt like forever, and then suddenly began climbing almost effortlessly? The move seems dramatic, but it did not appear from nowhere. The energy was building during the entire consolidation period. The range was the preparation. Another interesting aspect of long consolidations is the way they test traders emotionally. Many participants struggle with patience. They prefer action. When a stock refuses to move quickly, they abandon it and search for something else. Yet the patient trader understands that markets often reward those who can wait through these quiet phases. He studies the structure of the range, watches how price behaves near support and resistance, and observes whether buyers or sellers appear to be gaining subtle control. Because when a range persists for a long time, while pressure slowly builds, the eventual release of that pressure can produce a move far stronger than anyone expected. One of the hardest lessons a trader must learn is patience during quiet markets. It sounds simple, but in practice it tests nearly everyone. When a stock moves quickly, emotions run high and attention is easy to maintain. But when price drifts sideways or moves slowly within a range, many traders lose interest. They begin searching for something more exciting. Yet the patient trader understands that these quiet periods are often where the real opportunity begins. A consolidation phase is not wasted time. It is the market organizing itself. Buyers and sellers are negotiating ownership of shares, slowly shifting control from weaker hands to stronger ones. While the price may appear dull on the surface, important changes can be happening beneath it. Now let me ask you something. How often have you watched a stock for weeks, grown tired of waiting, and then left just before the move finally began? It happens to traders everywhere. The market has a peculiar way of testing patience. It will remain quiet long enough to shake out those who expect immediate results. Many participants enter a trade hoping for quick movement.